Ladies and gentlemen, please welcome to the stage Editor-at-Large of Bloomberg TV, Eric Schatzker.
Hello, ladies and gentlemen, and welcome to the second day of the Future Investment Initiative. It is an honor, a privilege, and indeed a pleasure to be back here in the Kingdom of Saudi Arabia. This morning, we will tackle a matter of immense importance to this country and to many countries in this region. Have we entered a new era of sovereign wealth? Allow me to welcome our panelists to the stage. Please join me, our host, Yasser Al-Rumayyan, His Excellency Managing Director and member of the Board of the Public Investment Fund here in the Kingdom of Saudi Arabia. Kirill Dmitriev, who is the CEO of the Russia Direct Investment Fund, of course, here from Russia. Khalid Al-Rumayhi, His Excellency, the CEO of the Economic Development Board and Chairman of Mumtalakat Investment Committee from Bahrain. Khaldun Al-Mubarak, the CEO of the Mubadala Investment Company here from the UAE. And finally, Jeffrey James Suwatit, Managing Director and Group Chief Investment Officer of GIC here from Singapore. Gentlemen, please. Let's begin our conversation with this. Sovereign wealth funds have never managed as much money as they do today. Their influence is growing, and some are taking an increasingly public role in defining the idea, the concept, if you will, of national prosperity. All of that, I'm sure you will agree, is undeniable. But the question before us today hints at something else, something perhaps more transformative. And let's answer it. Are we entering a new era of sovereign wealth? And if so, why? Yasser, would you begin?
I think we are. I can talk about PIF. We have changed our strategy since the inception of PIF, which was 46 years ago, from developmental aspect only to different types of investments. And we're covering a big spectrum of all of these investments. So I think we are. We're looking at things differently than the way we used to do for 40 plus years. We're not only looking at the developmental aspect, but we say it should make commercial sense, at least. We have list of things to look at, like governance, like impact on the economy, like returns, job creation, if we're doing it domestically, and it should take different boxes if it's going internationally. We're looking not only at conventional investments, but we're looking for some of the destructive investments. And I think the whole idea of this conference is the Future Investment Initiative is to look at the horizon and see what's the future going to bring to us and try to be part of this change. In the Vision Realization Program that we just announced today, we were, and also in the Vision 2030, we said that PIF is an investment powerhouse, a global investment powerhouse. And we demonstrated that by the kind of partnerships that we're doing. We're trying to have more active role in dealing with the asset managers, our partners, and the companies that we're in.
Well, that very nicely outlines the challenge for us in this conversation. The subject, or the topic, if you will, of a new era of sovereign wealth is something I'd like each of our panelists to weigh in on. Khalid, how about you go next?
Well, I think you look at the new era of sovereign wealth funds. And I think you see a trend towards moving not only and looking at outside markets, but looking more at the markets that they sit within as well. So what I mean by that is we've seen a great example of that in an announcement yesterday by the Public Investment Fund in terms of looking at major megacities, developing the national economy, and doing that on a commercial basis. So I see that happening across the world. I've seen that happen in a fund in Italy. CDP is doing that. I see that happening in Turkey where they've set up a sovereign fund. So there is a trend to look at inward investment on commercial terms, unconventional asset classes. And then in addition to that, you're seeing obviously a change in the investment climate globally, and there is an attention now being paid to new technology, to how to access new technology. So from an asset allocation perspective, increasing an asset allocation or increasing the allocation to new technologies, the technology sector, through public markets, and then obviously through private markets. And again, the SoftBank Fund is an example. There are many others where you're able to get in early and able to see to seed investments that obviously can have an impact on the national economy. More importantly, you can't just be invested in traditional asset classes. You have to look at the new technologies. And I think sovereign wealth funds have the ability to have deep pools of capital with an ability to take a long-term investment horizon. That can't be done by private equity funds at times. And so sovereign wealth funds have the ability to play that in a way that typical investment funds couldn't play that role.
Kirill.
So I'd like to agree with Yasser and Khalid. I think this conference specifically really highlights that sovereign wealth funds are very different now than before. Frankly, I cannot imagine this kind of conference 5 years ago. And the reason is that previously, really, the goal of sovereign wealth fund was mostly to protect the wealth of the nation. But now I see 4 key elements that are emerging that are new and that have been mentioned by Yasser. And by the way, I'd like to congratulate him on the great success that we are seeing here today. First point is direct investment. So in 2012, sovereign wealth funds have only done 77 direct private equity deals. In 2016, it's 137 deals. And the amount invested increased from $15 billion to $45 billion of direct investment. A second point is really driving transformation of the economy. And we saw a great announcement about NEOM today, a great work that Khaldun is doing with his fund. And basically, sovereign wealth funds are really transforming internal economies as well. A third thing is building partnerships. RDI, for example, have partnerships with everybody who is sitting here, except for GIC, and we are working on the GIC partnership. And the final point is technology. We really believe that technology will drive things going forward, and sovereign wealth funds, as we have seen yesterday, are playing a much more active role in technology. So those 4 elements really make sovereign wealth funds of today different from them 5 years ago.
Khaldun.
I agree with obviously what my colleagues have been saying, Yasser, Kirill, Khalid. I think there's been an evolution really in the way sovereign funds both operate and build their businesses over the last 20 years. I think all of us share, our shareholders are our governments. Our shareholders expect rate of returns. But also our shareholders have a long-term view. And I think that in itself makes us as funds take a different perspective than, let's say, the private equity and other forms of investment institutions around the world. But that also makes us closer together because we understand each other a lot better. So in my view, the evolution that's taking place is many of us are reaching a different level of maturity. Some of us are 40 years old, some of us are 30, 20, 10. There is a trust that is anyway within this club, and I call it a club of these sovereign funds. We trust each other, we work with each other. Many times over the last 20 years, 10 years, we found ourselves investing together in vehicles and funds in the United States, North America, Europe, and elsewhere around the world. But what we're seeing right now is these funds, I use us as an example, the 5 of us here on stage, we're actually working together now. I start with Yasser, for instance. We are co-investing together in big funds around the world and sectors like technology, where you find us working together as a well-coordinated team. We share views, there's a trust, there's a confidence. Some deals we invest in together, other deals we don't. But there's that level of commonality. With RDIF and Kirill, we have a joint fund. We deploy capital together. We've done over 20 transactions at least. We've deployed ourselves almost $1.5 billion together with Kirill in transactions in Russia. And by the way, by doing so, by entering into a new market like Russia that we don't know very well, that our assessment of risk was always challenged, having a partner, having a sovereign partner like RDIF made our life a lot easier, and de facto we were able to deploy and successfully deploy capital. We're doing the same with GIC, where there's another, I would say, trend that's happening where GIC is deploying capital with us through a fund that we're managing with third-party capital, with partners from France, which are Ardian. So you see a big evolution in the way we function from the classic days of 20 years ago where we were all working separately and deploying our capital with funds in the West, managing our funds for us.
Jeffrey, your perspective.
Yeah, thanks very much. I think there are a couple of very important observations to make. I think the first is that the fact that sovereign wealth funds now form a much larger percentage of total wealth, but also a much larger percentage of the increase in wealth every year has some very strong implications. So the first is that the patterns of capital flow that used to dictate, if you will, global cycles in the past has changed. So whereas it used to be, foreign investors out of the US or Europe that puts money into EM, every time there's a crisis at home, actually there's a home bias. Money flows back into the US and you see EM cycles as a result. So I think the question is that if sovereign wealth funds are now such a big driver of international capital flows, will it have the same pattern as in the past? Or will it now be one which has greater longevity in the emerging markets, doesn't drive the hot capital flows that have been the patterns of the past? So I think that's one observation. I think the second is that because it's concentrated in a smaller number of hands now, as opposed to many institutional investors spread out over many countries, we now call it 10, 12 sovereign wealth funds that could drive a lot of it. So I think some of the observations that are made, that were made by my fellow panelists around, do we think alike? Are we partnering? So the good thing is that where there is scarcity of capital, where there is a really good use of capital, we can channel the funds together very quickly and in size. But it's also true that because it's more concentrated, there is a risk that we end up all thinking the same way and in fact be responsible for more fluctuation in capital flows. So I think that remains to be seen. And the great message of hope, if you will, that has come out, at least out of the comments so far, is that we are long-term and we are looking for ways in which capital can be put to very good use over the long term, and it won't be so hot, if you will.
Sovereign wealth, as Khaldoon described, is a club. That said, and of course, as all of our panelists have illustrated, these funds are beginning to understand each other better and to do more business together to co-invest, but no two pools of sovereign wealth are alike. And so in the interest of helping you understand who it is that we have here on the stage, I'd like each of our panelists to say in a few short sentences what the purpose of your fund is, distilled as much as possible to explain why the challenges each of you faces is unique. Jeffrey, I'll go back to you to start this.
I think the thing about GIC is that we are solely a foreign reserves manager. So we're not allowed to invest in Singapore, and all our funds are invested outside of Singapore. And that means that our agenda really is investment returns only. It's not building institutions within the country or driving industries within the country. So that could be a difference for us. The second is that we've been set up as a kind of a one step apart professional manager. So although our board members include cabinet members and so on, there's a clear separation in terms of governance over investment decisions. That has allowed us in the past to make sometimes decisions that would otherwise be politically unpopular and so on. But it allows for a certain freedom in terms of investing and keeping to returns.
Khaldun.
We in Mubadala are an investment institution wholly owned by the government of Abu Dhabi. We have just merged 6 months ago with another sovereign investment arm of the government called IPIC. Combined, we are a $130 billion company. We have been formed with the objective of diversifying the economy of the UAE, and specifically Abu Dhabi. We invest both in the UAE and internationally. We try to create global champions in sectors and industries that are of interest to us. And we do so by investing with partners. We have a very partnership-driven approach. We take a more active role in these investments and these partnerships. And I'm proud to say that pretty much every one of these funds around me here on this panel are partners of ours somewhere or another.
Khalid.
Mumtalakat is a relatively young fund, probably one of the youngest on this panel. We're about 11 years old. It's initially started, although that's evolved, as a holding company for key government assets, whether it's the national airline, the national bank, the national telco. We started with basically having these assets to professionalize and maximize value. And we've grown over time through exits of some of these holdings, through IPOs and otherwise, to reinvest those proceeds. I think our main goal is to generate investment returns for the state. We make investment decisions based on commercial return. However, we look for an angle that has, even if we have the freedom to invest both domestically and internationally, but we look for an angle that benefits the country itself. And I would just add, most recently, we also see an objective of having a role to develop the national economy. So again, while looking at investment returns, we want to address market failures. We want to address areas where we're not seeing the private sector step in, and can we structure a solution with a partner, because the commercial partner validates the commercial sensibility of that investment, to correct a market failure. And I can talk about that later in terms of what we do there.
Kirill, distill for us, if you will, what the RDIF is all about.
Yes, sure. So first of all, I'll compete with Khalid because we are definitely the youngest fund. We're only 5 years old, so 11 doesn't count. And we were really set up as a partner for foreign investors to invest in Russia and abroad. We've built about 20 sovereign partnerships. So I think we are one of the most active partner builder among sovereign wealth funds because that's our mission. Our focus is return. We've been able to produce return in the teens in dollars every year for the last 5 years, despite some of the difficulty of the Russian economy. And I'll give you a couple of examples. So we started with Russia-China Fund first, where us and China Investment Corporation put $1 billion each. We created Russia-China Funds that has done 15 investments. But also, in addition to return, we try to have some interesting projects that highlight cooperation between nations. So, for example, we invested in the first ever toll bridge between Russia and China, actually the first bridge between Russia and China. Very important PIF relationship we have. For example, PIF invested with us already more than $1 billion into Russian economy, and during the visit of King Salman, one of the key announcements was their investment in a toll road in Moscow. So we believe we're moving from return, which is our focus, to some good stories between nations, to really positive effect on economic diplomacy. Because when nations invest together, relationships between them really improve as well.
If I'm not mistaken, Yasser, the public investment has the broadest mandate of all the institutions on this stage. Do your best to tell us how you think about it.
Again, with the new strategy, we have a wider spectrum of investments. So we have 6 pools of investments. You can say it's like 6 different funds. The first one is the international investments, and this covers all kind of international investments, from investing directly in companies or being in partnerships with some of the fund managers and asset managers. Then we have the international mega partnerships, like what we've done with SoftBank, along with Mubadala, $45 billion commitment. Then another fund we announced with Blackstone, which is $20 billion commitment of a $50 billion fund. Then we have the four domestic pools of investments. The first one, which is the mega projects. This would include projects like NEOM, which was announced yesterday, the Red Sea, the Qiddiya Entertainment Hub. We have the real estate and infrastructure pool, which covers all kind of real estate projects, something like what we're doing in Mecca and Medina and Jeddah and Riyadh and all over the kingdom. Then we have the sector development, and we've announced in the past few months number of different companies like the waste management, like the entertainment company, and finally we have the Saudi equities. And in this pool we have over 80 different companies. And currently this pool of investment represents more than 70% of all our investments. So, and the reason why we consolidated all of these pools of investments under PIF is the board that we have. It's an excellent board chaired by the His Royal Highness the Crown Prince, and we have ministers from all over the government. We have the Minister of Finance, the Minister of Energy, and the Minister of Economy and Planning, and other ministers. So this would bring more of coherence of the government into doing the same, enabling us to tap in all of their businesses and in the government. So this would add a lot to what we're doing domestically.
On the way to my next question, I'd like to introduce an example from far away that I don't believe any of you has an involvement with, but may yet prove useful. Last year, it comes from Canada as a matter of fact, last year the government of the Canadian province of Quebec paid $1 billion for a 49.9% stake of a new airliner being developed by a company you may know, Bombardier. And the idea here was one that all of you are familiar with, to ensure that this project and all of its high-value jobs, its technology, and its supporting ecosystem stayed in Quebec. But Bombardier stumbled and spent too much money developing this jet, and last week it had to be rescued by Airbus. Airbus paid $0 in exchange for 50.01% of the project, and Quebec, which as you will recall paid $1 billion, now has 19%. We can all do the math. Here's the question, and I think it's a relevant one for almost everyone on this panel, perhaps save Jeffrey. How do you reconcile the conflicting priorities of investment versus development? Khaldoun, why don't we start with you?
Yes, it's always a challenge. There's no question about that. I think you have to be able to define as an investment institution guidelines and really stick with them. You have to decide your risk appetite, you have to decide your target rate of returns, you have to decide the sectors you want to invest in and the geographies you have to invest in. And then you have to put a governance structure in place supported by your shareholder, here respectively our governments, that believes in that governance and believes in that strategy and that vision. And then the management team has to stick with it and then be obviously compensated properly for that, but also when you underperform, you have to also suffer the consequences. When it comes to development, development has to fit, obviously, if it's the strategy of that investment vehicle, within that context of that vision and that governance. Development is very important. We do a lot of development in Mubadala. We do it in multiple sectors. Aluminum, as an example, is one sector. Healthcare is another. Aerospace is another. You really have to stick to discipline. You have to agree your targets with the government, and then honestly, it's very important when you look at development that you have a long-term sustainable view for that business. Building an industry that is subsidized, or an industry that doesn't have scale or a cost advantage, or an ability to compete internationally from a cost perspective, at the end of the day might achieve short-term objectives in terms of job creation or in terms of GDP contribution, but eventually, a year, 2, 5, 10, it's going to be a problem. And my strong advice would be to stick to investment principles, do development because it does work. And I think we've had great examples in the UAE of development projects that have been very successful, achieved both objectives, the investment objective and the development and value-added objective for the economy and for the community.
Khaled.
Yeah,
I saw you nodding your head.
there's a portion of the investments where you can meet both the development objective and the return objective. And I agree with Khaldoon. What you do is you put in the right governance, you put in the right professionals on the board who are independent, who give you feedback just to make sure that you're investing based on commercial principles. The problem becomes when you have state assets that are on your portfolio that basically you have jobs attached to them, but there is a challenge in terms of making it commercial. And I think what we found is maintaining that discipline is extremely challenging. What we found is we say, and we did this with our national airline. Our national airline, as we all know, airlines are extremely challenging businesses. And what we found is A, professionalize the board. Number 2, tell the government, I will invest and continue to invest in this airline only if it meets certain returns, KPIs. And we managed in Mumtalakat to reduce the losses by about 90% in the span of 2 years. And we did it by downsizing. And so we had that active discussion with the government, because if you don't have a sustainable plan in place, then I don't think development really takes place. If you do something that doesn't have a complete commercial sense, it's not sustainable. It's not going to protect those jobs long term.
There's a word that keeps coming up, which is returns. And I suppose we should all be happy that it does. Yasser, you told me yesterday that the PIF hopes to double its returns to the high single digits from where it is today. Share with us, if you will, some of the ways that you plan to achieve that, including with the use of leverage and also diversification.
Currently, we're about maybe 3% return, and we just issued in our VRB Vision Realization Program that we want to increase it by 2020 to a range between 4 to 5% return. And beyond that, definitely it's going to be in the high single digit, between 8 to 9%. And the way we arrived to these numbers, as I told you yesterday, we looked at the benchmark for all the sovereign wealth funds around the world, the long-term investors and the endowments, and we found the results between like 3% to maybe 11%. There's a big difference between 3 and 11 or 12%, and the reason is the different underlying that we're in. Some of the investments in some of the sovereign wealth fund, it's like for developmental purposes, right? So that's will give you a lower returns. If you go towards the PE type of investments, which is less liquid with a longer term view, it will give you definitely a higher return. If you add some leverage to it, that will improve your returns. So we're looking at different techniques and underlyings and investment underlyings and universe to try to improve our investments. We, at the same time, have different KPIs, and it's different from one pool to another. I'll give you an example. In the domestic pools of investments, we have like we want to have job creation. So we're promising that we're going to create like 20,000 jobs by 2020. We want to have more GDP participation. Currently, we're participating by 4.4%. We want to increase that to 6.3%, which is almost 50% increase in our participation. We want to increase the local content to $13 billion by bringing some of the partnerships that we have abroad back to Saudi. So it's different KPIs. The return is the most important one.
Jeffrey, GIC has a tradition, let's say, of being quite public with its view on returns, and perhaps appropriately conservative in its views. GIC increasingly is looking to technology and healthcare as sources of return, and you've invested in companies ranging from Alibaba to Square. The PIF has invested $3.5 billion in Uber. Tell us, is that what sovereign wealth funds increasingly need to do to generate their own alpha by identifying innovation and structural change and investing in it directly?
Well, I think one of the theses we have is that technology has reached a point where it can create disruptive change at a pace that we've not seen before. And certainly we've seen it in, e-commerce attacking retail, or social networks effectively changing the way in which kids and people interact, and so on. So I think sovereign wealth funds historically have taken a very traditional, endowment-like approach, which is to say, well, if we get our asset allocation right, a little bit of equities, a little bit of fixed income, we should be able to get good returns. And in the 80s and 90s, that generated wonderful returns because you had high interest rates that were falling and everything kind of floated up with it. But I think in a world where our starting rates are so low and equity valuations are so high, those traditional asset classes won't generate the returns. But more importantly is that if technological change is happening, or that growth is occurring outside of the regions, so for example, the US is 55% of MSCI World, China's only 3%. Well, where is the growth going to come from? Is it going to come from the US or more likely from China? So by sticking with traditional benchmarks and indices, we're likely to actually be doubling up our bets, if you will, on industries and regions that are likely to grow slower, likely to be more disrupted. And so for us, it's been fairly important to have an eye out on what is being disruptive, what is actually growing the fastest. And actually, one of the great joys of coming to this conference is that the focus is fully on the future, on what incremental changes are happening, what disruption is happening. And it's important not only for investing in the disruptive technologies where the returns could be great, but just as importantly because the portfolio that you currently have is probably being attacked by all kinds of companies. And sometimes the pain happens on the existing companies before the profits come elsewhere. Amazon has barely returned great profits, but retail across the US has already suffered a great deal. So that's why we think it's very important to focus on those areas as much defensively as it is offensively.
That leaves me wondering, in the effort to identify and capitalize on disruption, how do you make the right bets? How can you be certain that you're not making a mistake, if you will? Who wants to take up that question? How do you think about it, Kirill?
Well, going back to returns and addressing this one, I think there are two basic ways to have better returns: is to focus on growth areas or focus on cost efficiencies. And basically, when we think of technologies, we don't think about them in abstract terms. I'm on the board of Transneft, which is the largest pipeline company in the world. So when we have a technology that can reduce capex of Transneft and that Transneft can buy and use, we already have a very significant customer that we know we can test it on and then have revenue from. So I think for many sovereign wealth funds, their huge portfolios that they have provide a huge testing opportunity for technologies and allow us to majorly de-risk technologies. We, for example, invested in Didi Taxi in China very early. We expect DD to enter the Russian market at some stage. So building those alliances with technology companies that enable them also to enter your local market and get good valuations and de-risk them, I think is a very important way forward.
I'd like to ask a question about infrastructure, because to me it seems like the perfect investment for a sovereign, critical to economic development, long-term in nature, and with the potential to generate a lot of cash. Provided your mandate allows it, are there any good reasons not to invest in infrastructure?
Let me take a stab at that. I don't think so. I think that, I congratulate Yasser and the announcement that he made yesterday about the infrastructure fund that I think is going to be done with Blackstone. I think infrastructure, by virtue of, two things that apply here to the Gulf. Number one is our governments are necessarily going to step back because of the low oil price environment. And so that's going to create an opportunity. So governments can no longer fund the infrastructure, the roads, the bridges, and so forth. And so I'm not surprised that private investors are looking at this. They typically have. We see examples of infrastructure funds that have done this. And I think, why shouldn't sovereign wealth funds co-invest in that asset class? It's going to generate stable returns. It's going to be long-term in nature. It requires deep pools of capital. All of those are present in sovereign wealth funds. So I think that there's an opportunity that's going to be open, certainly in the Gulf and probably in the wider Middle East. I think private capital is going to look at that, and I think sovereign wealth funds should look at it, and I think it provides bond-like returns. And as long as you are looking at assets that, and the regulation around it, and I think all the governments now in the region are looking at regulation around PPPs, risk sharing, and what have you, and I think it provides a wonderful opportunity for sovereign wealth funds to step in and earn returns while serving a development function.
I think one risky thing about infrastructure that you've got to think about is government changing the rules down the road. And there was a consortium of medium investors from the region invested in a Scandinavian country, where Scandinavian country completely changed the rules after the investment. So I think that risk factor needs to be taken into account and needs to be de-risked. For example, we like to build big consortium and also invest with pension funds, because once pensioners' money and the infrastructure project, it's more difficult for government to change the rules. And Russian government, for example, provides some additional capital grants to ensure that returns are possible for private investors. So for an infrastructure project, Russian government would typically top up enough capital so that investors can make good return, and that allows not to sacrifice return on infrastructure projects.
Khaldun.
Yeah, no, we like infrastructure a lot. I think it's the question is more from our perspective, do we want to take the development risk or go into infrastructure with that, once they're cash flow generating assets? We like infrastructure that's cash flow generating. And we've done investments, we have a wonderful, as an example, iron ore port in Brazil, fantastic piece of infrastructure, state of the art, performing very well, steady cash flow. And again, in a market that has suffered in the last 2 years, Brazil, iron ore, again, iron ore port doing very well, strong, and I think is a good long-term investment for us, the type of investment that fits our infrastructure category. We're doing some interesting stuff with RDIF. We're looking at toll roads in Russia. And again, we're looking at cash flow generating assets from that perspective. They do very well, we like them. Sorry, the airports business we're doing in Russia, we're doing in Southeast Asia, South America also. It's a good business, particularly designed for, I think, funds like ourselves. It's quite an asset.
And as you consider those investments and as you make them, are you thinking, does your investment horizon, do you find that you extend it? Many of you are investors in private equity, not all of you. Private equity's time horizon is somewhere between 5 and 10 years. Infrastructure requires a longer time horizon, but given the fact that we're talking about sovereign wealth, can you think about your capital in almost permanent terms?
Not really. I think as long as it's generating the right cash flow, the right returns, and then if it reaches a point of maturity within the investment life where it's time to to monetize. We normally like to do that. But you know, the thing with infrastructure, particularly when you're dealing with government risk, so I'll give you for instance, a bad example. We invested in a concentrated solar plant in Spain, which was a great project when it was done, a great project when it was delivered, but then there was a government change, and then the government decided to change the tariff. And I think that's a problem. So suddenly what was an attractive rate of return became an unattractive rate of return, and you're stuck. And then to exit, you're going to have to take and that's ultimately we had to negotiate hard with the Spanish government to try to restructure the tariff structure. It's okay right now, not what we had anticipated, nor what we would have wanted. But I think the lesson here, and the lesson for governments, if you're going to go down the infrastructure route, and if you go down the route of attracting foreign direct investment or private equity investment into that sector, you have to stick to the rules. I think for us, I would think not just twice, but 3 times before we deploy again in Spain in that type of investment.
There's a natural fit between these long investment horizons of sovereign wealth and private markets. In many cases, sovereign wealth funds don't need the liquidity of stocks, bonds, currencies, or commodities. So, Jeffrey, I'd like to ask you this question, and anyone is free to jump in afterward. Where do public markets fit in your thinking these days? Do they matter as much anymore? And if you invest in public markets, are you better off doing it through passive instruments like index products and ETFs?
I guess the nature of private investments are that they're actually pretty hard to surface. It takes a lot of work. And quite often, the people who already own those assets, so it might be founders or founding families, may not need the money. And so it's at the point where you want them most, they may be actually hardest to find. So I think even we see today with all the GPs having raised wonderfully large funds that they haven't actually deployed a large bulk of them. So if you want to be disciplined in terms of targeting a certain rate of return, then the ability to deploy large sums in private markets is a slow process. And I think with the flood of investors really wanting to target higher allocations to private markets, it'll be very slow to be achieved. In the interim, that means that in public markets remains the one liquid instrument where you can put money to work quickly. And so I believe, even for those of us up here, public markets will remain an important area of investment. And the question really becomes one of, with lower rates and higher valuations, how do you find the right few idiosyncratic public investments to make as opposed to sort of just putting it out into an overvalued asset class?
And what about the active versus passive question?
It's been hard because active investors haven't covered themselves with glory at all in the last few years, in part because the style has been historically very value-oriented, and those value companies just haven't generated the growth that's been needed in a relatively weak growth environment. We think that as more money flows into passive, as more money flows into ETF, more and more assets will get mispriced at some point or the other, and that will create its own potential for return for active investors. So I don't think active investing is dead. There will be a balance, and maybe we're trying to search for a better balance than we had in the past.
Does anyone else have a perspective to share on this question of the value of public markets versus private, passive versus active?
We're doing both. Actually, we're doing, as I said, most of the...
Pretty much everything.
Everything. The active versus passive, currently most of our investments are passive investments in the sense. I'm not talking about the underlying, whether it's an index fund or ETF or going and buying direct equities, but we're doing it through asset managers. So we, up to this moment, we're not doing it internally within PIF, but eventually as we grow our capabilities and bring in more people, we will be, and also the research capabilities, definitely we will be considering active investments in addition to whatever we're doing right now.
You mentioned third-party asset managers. It raises a question for me. Many of these firms, some of them may in fact be in this room, have grown wealthy and powerful by charging management fees and keeping a share of the profits earned on the investments that they make. Of course, the more that they keep, the less there is for you and for your stakeholders. And so I wonder, going back to this point that we made initially about the growing influence of sovereign wealth funds, whether they should use their newfound strength to continually make an effort to extract a better deal from these firms.
They have to be incentivized, that's one. But there are different structures now for fee structures and what have you. And this is, I mean, the bigger the relationship that you have, the better, I think, terms you will have.
A question to conclude very briefly. Some quasi-sovereign funds, Canadian pension plans, Australian superannuation funds, rely less and less on the use of external managers and more on internal investment teams, often at a lower cost. Is that a realistic goal for sovereign wealth funds, to build internal expertise and to do more of it on your own? And even if it is, what stands in the way? Kirill.
Well, first of all, I think that traditional GPs will stay for sure, and they have tremendous amount of expertise and knowledge and know-how and experience that will not go away. So we will never see a model where just sovereign wealth funds, no GPs, they play an absolutely critical role. But I think we'll see a model of coexistence and real partnership, where GPs are offering more co-investment opportunities, some areas are built within sovereign wealth funds, and frankly, it makes for a more educated and better investment decision. So I think we will move to a world where GPs will co-invest with some of the sovereigns, but as I mentioned, the direct investment amount of sovereigns into private equity is only 45 billion, which is, much less than trillions of dollars under management, and GPs will continue to play an absolutely critical role.
Khaled.
Yeah, I agree with the gentleman. I think that there's a hybrid model. And I think that in Mumtalakat we have sector focus, and we've developed teams around logistics, around financial services and so forth. What we've done is partner with GPs to take minority equity interests. And we've actually done that direct investment. So it's a co-investment. We go sit side by side with them. We do the due diligence. And we find that there's a learning experience out of that. There is an ability to sit on the board and understand and influence. But I think there's that knowledge transfer, because as you see that investment, and again, it's a commercial investment, you have the ability to bring back some of that investment home or to duplicate that investment and do it on the national level. So it's building skill levels, but it's not to the exclusion of the GP. I think it's sitting side by side with the general partner and allowing some knowledge transfer.
Khaldoon, Jeffrey, I see you both nodding. Does any of you want to add anything?
Yeah, no, I agree 100%. It's both. And we've done a similar thing. We've invested in GPs. We've invested, for instance, in the Carlyle Group. We've invested in the Related Group and real estate in the United States, and Rain and their media. And it's been a great experience, because from one perspective we're learning, from another perspective we're forming great relationships, and it's giving us access to deal flow. So it's a good relationship, and I think that they're the best in their fields. I look at Steve here, Blackstone. I mean, there's a reason why they're good at what they are. They've been doing it for much longer than us. They have a much bigger bench, but we have to build our bench too, and I think they accept that.
I agree. I think you cannot respect enough the skill that's needed to do some of these things really well, and to be able to partner with the most skilled in the world is an important one. But maybe, I would say, along with the idea that there is knowledge transfer as our teams, do the work to invest with them, that we will learn things. But there are also areas where, GPs are not involved or not as heavily involved that are closer to home. So for example, in Asia, we have relationships, we have, if you will, some insight into into what drives the economies, and therefore to be able to build teams that can, work directly on some of those within the region that we have some skill, if you will, is the right one. And I think everyone here within our own regions will have that edge even over some of the GPs.
Yasser, as our host, if you like, the last word is yours, sir.
I mean, just to answer this question, we would like always to improve the performance of our people within, but that won't stop us from going and finding the best. There are different propositions from different managers, and we always like to partner up with the right people. And manager selection is an art by itself. So we would always go out and find some good partners.
Well said. Ladies and gentlemen, your perspective on the new age of sovereign wealth. Please join me in thanking our panelists.
Ladies and gentlemen, this concludes this morning's session. Our next sessions begin promptly at 11 a.m. over at the Ritz-Carlton. We encourage you to visit the Gigaprojects Expo. Also, you're invited to join us for our coffee break over at the Ritz-Carlton. Thank you.